Hi, dear students. Welcome to this special session. And sorry for the 10 minutes delay. There was a technical glitch. I'll just share the link, right? Yeah. So welcome to the session again. We have this 3 hour special session where we can discuss your query, how to approach the accounting standards, and difficulties you are facing. I'll be here throughout. I'll be, working with you. And whenever some student has some doubt, any topic, it can be, if you have a doubt in a specific concept, if it can be, if you have a specific problem to be solved in this session, if you feel that, a particular examination question has to be solved in this session, I will be here to solve all of that, right? Now, it should not be a generic doubt as to, explain the entire standard. That is not the purpose of the session. Let's say you have a specific doubt as to replacement cost if it comes to, inventories, right? So you will need to ask me in the chat box, and whenever I see a question, I'll take up the question and I will answer it for you, right? Good afternoon, everyone. Good afternoon, Sweetie. Good afternoon, Jyoti. Good afternoon, Siv Chaitanya. Okay, sorry for the small glitch. And in the meanwhile, when you start asking questions, let me share something which is very important for us to get the context of why we are having this session. I hope you are able to see my screen. Now, the topic why we chose accounting standard is it's very important from your examination point of view. And in fact, if you have to look at the past paper analysis, I'll just take you through that. See a past exam analysis, and let's take up accounting. Now, in accounting, if you can see here, the weightage, on an average, 27.5 marks, 20 to 25% is the weightage given by ICI. These standards in red have been moved to group 2, but every year, and all of us would know, right, the first question, that is a compulsory question, is from the standards, and the other questions in the short notes and all that also you get from the standards. So that is one thing which you should be aware of the importance. This is with respect to your group 1, and similarly if you look at group 2 accounting, advanced accounting analysis, so here you see again 24-25 marks. So the idea is, if you can get this 20-25 marks in the examination, and let me tell you with my own experience, it is easy to score once you are clear with the concepts. There are smaller questions which are asked, and most of the times they are repeated questions. It'll be easy for you to answer, and if you can pocket this 20-25 marks, even if you score 16 to 18 marks, a lot of burden from the remaining topics is reduced. Okay, so that is the idea of having this session where we can clarify your doubts, where we can take up your questions on accounting standards. Now, feel free to ask any question, any topic. Let me know what you want me to take up in this particular 3-hour session. I'll pick up that topic and I'll explain it to you, solve questions for you. I'll help you answer questions in the examination. Now, till the time you ask questions, some questions which come to us regularly is how to answer case study based question. So basically, if at all there is a question on accounting standards, so let me just take you through one of the past exam papers. So let me take it through maybe a group 1 accounting question paper. So we have this questions, right? Now, what questions we get sometimes is questions like this. You can see this question number D out here. ABC was making provision for non-moving stocks, and now this is provision required based on technical standard, provision required based on last 12 months issued. And this is a case study based question, and students ask us as to how do we answer these kind of questions. And again, let me tell you, this kind of questions have been asked again and again in the examination. It's not the first time that this question is asked. This was already asked in a couple of earlier attempts, and I think it's also available in the study material. So how should we answer that? Right. So when we answer that, though the institute has not, given the reference to the accounting standard, you have to make a reference to the accounting standard and you have to explain what accounting policy, right? Then whether the change is an accounting policy change or not, that decision you have to give. And then after that, you have to give your conclusion. Now, in this question, now, for example, in the second bit, it more fits up in the question. In the books of K Limited, closing stock is valued at so much, and then company decides to change from FIFO method to weighted average method, right? Then the cost is so much, realizable value is so much. Disclose the disclosure requirements of change in accounting policy. This is not a direct case study based question, but again, if you have to answer that, you have to make references to the standard. You have to explain what is the question about. Right now, in this case, the question is about accounting standard one, and it is asking us about changes in accounting policy. So if there is a change in accounting policy which has a material effect, it should be disclosed in the financial statement. So if I have to explain this in a language related to law, this is what is the provision. So you have to explain the provision, you have to explain the case, you have to analyze the case, and then you have to give your conclusion. This 3-step approach, if you follow, you'll get full marks in the case study based question. Other questions are purely your numerical questions, so that should not be a challenge. Right. So I have some questions here. Is there any change in the approach for CA IPCC students for inter? No change at all. Accounting standards remain the same. In fact, you'll get one extra mark. Earlier they used to ask same question for 4 marks. Now same questions are being asked for 5 marks. So that is one advantage for you. Is this a revision session or a doubt session? This is a doubt clearing session. If you don't, as and when students ask doubts, I will be answering those doubts. Otherwise, I'll continue with my work. I'll be working. Whenever, if you have a doubt, if you want to ask a doubt, you can ask the doubts here. Right. So let me. Let me pin this comment so that. Yeah. Come on, guys. This is the opportunity for you to, clarify your doubts. You have any again, when I say doubt, it can be concept also. If you have not understood a specific concept in the accounting standard, I'll be happy to, address that for you. Okay, so if you don't have doubts, let me ask some questions, so that you can evaluate yourself whether your understanding is correct or not. So when we talk about accounting standard 11, right, monetary items and non-monetary items, whether inventory is a monetary item or a non-monetary item. Let us see how many of you can answer it correctly. Inventory, whether it is a monetary item or a non-monetary item. So I'm waiting for your answers. Concept-wise revision for Group 1 and also for Group 2 is already available on our channel. You can get in touch with our support team or you can search our channel. You will find it there where we have revised it thoroughly. Okay, I got only one so far. Inventory, monetary or non-monetary? Monetary, one answer non-monetary, second non-monetary. Come on, guys, because see, that is this understanding is important. And let me tell you, you'll be using this concept even in your CA final, right? Okay, so got few responses. Monetary, some of them are saying non-monetary. Now, friends, please understand when we talk about monetary items or non-monetary items, monetary items and non-monetary items. Monetary items are measured in determinable amounts of money. That is, what is the amount that you will realize out of that particular item. For example, you have cash in hand. When you say cash in hand, you know how much of cash you have in hand, or you say cash at bank, or you say debtor. Now, if I have a debtor or if I have an account receivable, I know exactly how much that particular debtor has to pay me. Okay, so such items are monetary when you know what is the amount you will realize from that particular asset, or what is the amount you have to pay to settle a particular liability. When it comes to items like inventory, though we know the cost of inventory or though we know the net realizable value of the inventory, we do not know exactly what is the amount we will realize in the future when we sell that item of inventory. See, today we may value inventory at 100. Maybe after the financial year ends in the next period, we will sell it at 90 only, or maybe we will sell it at 110. So that amount of money is not fixed. And hence, inventory is a non-monetary item. Inventory is a non-monetary item. It's your property, plant, and equipment, they are non-monetary item. Right? Your investments, those are non-monetary item. Okay, so that is how you have to understand. Though we measure it in terms of money itself, but of money that we would realize, that is not certain, that is not fixed, and hence it is a non-monetary item. Okay, then let me take up one question till the time you have other doubts to ask me. I'll just share my screen so that just give me a moment. I'll take up a question on foreign exchange again. It will help you to understand the concepts better. I hope you are able to see the screen. Now, this is one question on accounting standard 11. Okay, this covers 2-3 important concepts which you'll be able to understand after we solve this. But I'll not be solving many more questions. I'll be solving questions which you have a doubt in, or any concept which you have a doubt in. Right. So till the time we gather the questions, let me solve this. A very important question. These kind of questions do keep coming in the examination. PP Limited, an Indian company, acquired on long-term finance from WWP Limited, a US company, amounting to 40,88,952. Right. So that is the first thing. Give me a moment. The transaction was recorded at $72, taking exchange rate prevailing at the date of the transaction. The exchange rate on the balance sheet date is $1 is equal to 73.60. First set of information. Second, trade receivables of PP Limited include amount receivables from Peksha Limited, rupees 20 lakhs 150, recorded at the prevailing exchange rate on the date of sales, that is $1 is equal to 73.4. The exchange rate on the balance sheet date is 73.60. Exchange rate on 1st April 2020. Exchange rate on first, that is opening exchange rate, is 74. You are required to calculate the amount of exchange differences and also explain the accounting treatment needed in the above two cases as per AS 11 in the books of PP Limited. Now, there are two set of transactions. One, they have taken a long-term finance. They have taken a long-term finance, which was originally recorded at 72. Okay, when was this transaction done? That is not given in the question. The exchange rate on the balance sheet date is given to be US dollar 1 is equal to 73.6. So whatever is the difference between this 72 and 73.6 is your exchange difference. Now tell me one thing. Is this a case of a exchange gain loss, or sorry, not exchange gain loss? Is this a case of exchange gain or exchange loss? Can you quickly tell me whether it is an exchange gain or an exchange loss? Quickly. Was the answer given? Exchange loss, right? Now, what we need to do here is, let me just, take an Excel here. I'll just, note it down here. I hope it's visible. The screen is visible. Okay, so first is long-term finance. What does the question say? It's 40, 88, 952. So 40, 88, 952 is the amount in INR. Okay, this is INR. What is the exchange rate? Exchange rate, the question mentioned, is 72. So that is the recorded transaction date. Okay, so what you need to be careful about is what is the date, and we don't know when the loan was taken. The question has not mentioned when the loan was taken. So this exchange rate on 1st April 2020 is 74 is not relevant to us, right? So it says that transaction was recorded at 72. So if I put exchange rate at 72, what is the USD equivalent? USD equivalent is 40,88,952 divided by 72. If I divide this two, I get 56,791. This is the loan amount. This is the loan amount. Now, how much is the exchange loss? Now, exchange loss is, the question says the closing balance or the closing rate is 73.60. So exchange loss is 73.60 minus 72, what is the loan rate which is taken, multiplied by 56791. Exchange loss comes to 90,866. The exchange comes to 90,866. Now, what do we do with this exchange loss? What is the treatment for exchange loss on long-term borrowing? What is the treatment for exchange loss on long-term borrowing? See, if you don't ask me questions, I'll start asking you questions. That's how we can learn. Come on, what is the treatment of exchange loss on long-term borrowings? Is the second option. What is the first option? Capitalize is correct, provided you have purchased an asset. Okay. But what is the first option? That's the second option what you told. What is the first option? What do you do with an exchange loss? P&L. Very good, Jyoti. So exchange loss will be debited to P&L. Alternatively, it can be accumulated to FCMI TDA. You can expand the thing, foreign currency monetary items translation difference account, right? And amortize it, over the life of the asset or the life of the loan, whichever is more relevant. Okay. Now, this is just a brief, conclusion of what I wrote. In the examination, you have to write, elaborate it slightly more. What will you do if it is a depreciable asset? What will you do if it is a non-depreciable asset? It's a 2.5 mark bit. And once you do this, the 2.5 marks is in your pocket. Now, looking at the second bit, what is the second bit? Pretty simple. 20 lakhs 150 recorded at the exchange rate of 73.4. Closing rate is 73.6. Now, is there a gain or a loss? Now here, because the exchange rate increased and we have to receive the amount, it is a gain. It is a gain. Now, what do you do with the gain? The gain will be taken to P&L. As simple as that. And nothing, complicated here. Whatever is the difference, that is 73.6 minus 73.4. So again, here also we need to write. This is 73.6 and 73.4. How many dollars? Let us compute. Receivables in INR is 20 lakhs 150. Okay, exchange rate. $73.4. So dollars. Equivalent USD is this divided by this 7,250. Gain is how much? 73.6 minus 73.4 multiplied by 27,250. You get 5450, which will be taken to PN. Question, a 5-mark question. Right? So this is how we can approach. These are the same. This was again. These kind of questions are generally repeated, and if you have covered last 3-4 years of examination question papers and also the RTPs, and also obviously the problems which you have done in the class, that will be more than sufficient for you to handle accounting standards. Now the window is open to you. Whatever doubts you have with relation to accounting standards, I know there are complex standards like AS 19, you have AS 22. Somebody asks AS 22, I need a specific question. Any specific question on accounting standard 22, I'll be happy to answer that. Then you have earnings per share. If you have any question on that, any standard, any topic, any concept, any question you have, please to us. Please ping us in the chat box. I'll take up that question and I'll solve it for you. Okay. So and then I'll also be continuing to work. And as and when someone has a question, I'll take up that question and I'll address it for you. This is an opportunity for you to get your doubts cleared. DTA, DTL question, please. Okay, thanks, Wasim. So let me see if there is something in the current RTP. We can take it up from that. There would be definitely some question in the RTP. Let me pick up one question. Oh, it is in advanced accounting, right? My bad. Okay, so now Wasim, you had asked a question on DTA and DTL, so I'm taking up one question from the current RTP. I'll quickly explain you also the concept of when you should say call it a DTA and when you should call it a DTL as we solve this particular question, right? So I hope it is visible to you on the screen. This is from the current RTP of May 22. Advanced accounting paper, question number 19. That is what I am, I'll be discussing with you guys, and also explain the concept of DTA, DTL when we should do in this video. And we do have a 2.5 hour long full length AS22 video on our YouTube channel. After the session, you can definitely go ahead and watch that, right? Just a second. Right. Now, what is the question? Sorry. Yeah. What is the question? The following transactions were reported by PQR Limited during the financial year 2021. Okay. Tax rate 30%. Fine. Items disallowed in 1920 and allowed for tax purposes in 2021. How much is that? 20 lakhs. Now, friends, before we move into or jump into solving this question, okay, let me tell you underlying or the quick way to remember when we should call a DTA and when we should call a DTL. Okay. We are talking about accounting standard 22. DTA, DTL. First thing, this deferred tax asset or deferred tax liability arises because there is a difference in the accounting income and taxation income. Basically, for example, let us say accounting income. I'm just giving a very simple, I'm not going into details of logic, that is covered in our full lecture. Okay. And it's available on YouTube as well. Accounting income, it's before tax, assume it is 100. Simplicity sake. Okay. Then less amounts disallowed. I hope all of you have learned PGBP in income tax, right? Amount disallowed 20. Okay. Sorry, it will be add because it's a gain, it will not be less. Add amounts disallowed 20. And this is your taxable income, which is 120. Right now, this amount which is disallowed in the current year, assume this is the current year or this is year 1. Amount which is disallowed in the current year, which is 20. What has happened because of this? We had to pay more tax. Please think of this. We had to pay more tax in year 1 because this 20 was disallowed. Otherwise, if everything was allowed, our tax would have been 100 multiplied by 30%, which is 30. But because this 20 is disallowed, now we have to pay 36 taxation, meaning to say we pay 6 rupees extra as tax. We paid extra as tax. Now, let us say we come to year 2. Let us say we come to year 2. Now, in year 2, say for example, accounting income is again 100. It is again 100. And this amount which was disallowed earlier is now allowed. This is not account. Just a second, guys. Yeah, amounts allowed. Now this 20 was disallowed here. Now this 20 is allowed in the next year. So you'll do minus 20. Sorry. You'll do minus 20 here. Okay. And what will be your taxable income? Taxable income is 100. Now your tax, if you see, On this, it would have been 30. But now you have to pay only 100 minus 20, 80. Now you have to pay only 24. Now, if you understand this example, no, your DTA, DTL confusion will be done. Your DTA, DTL confusion will be done. Now, what has happened here? In this year, we would have paid 30 as taxation, but we ended up paying 36 as tax. Why did we pay more? Because an item was disallowed. Now, does it mean that because we have paid more in this year, we will never be able to benefit in the future? No. In this case, what has happened is you paid more here. Here you have paid more. In the future, you have to pay less. We can see it very clearly here. In the future, you have to pay less. In first year, when it was disallowed, we paid more. But when it was allowed in the future, we paid less. Okay. Now, when you are preparing financial statements of year one, you will think, or you will try to understand, I'm paying more tax now, but I will get a benefit in the future. Now, whenever I get a benefit in the future, an asset is created. So in year one, what you will do is you will create something called a DTA. Okay. Similarly, if it was the reverse case, if we had paid less now and will pay more in the future, there will be a deferred tax liability. Any item of deferred tax asset, wherever there is a temporary difference or timing difference, you will be able to fit that in this particular bucket. Okay, what are we paying now? Are we paying more tax now, or are we paying less tax now? If we are paying more tax now, and if you'll get a benefit in the future, it will create something called as a deferred tax asset. If we are paying less tax now and we have to pay more tax in the future, it will create a deferred tax liability. If you understood this concept, right, then answering questions based on deferred tax asset or liability will not be difficult at all. That this entire, this discussion what I had summarizes your DTA and DTL related concept. And please note, if there is a permanent difference, for example, which is never allowed, okay, then you have that 36(1) clause, subclause VA, what we have, where after the due date it will never be allowed in the future, okay, or some item is exempt. When those permanent differences are there, then there is no question of deferred tax liability. I hope the concept is clear. Now coming back to the specific question, what we have, items disallowed in 1920 and allowed, just give me a moment. Yeah, sorry. Items disallowed in 1920 and allowed for tax purposes in 2021. Now, what has happened? In 1920, we have created a deferred tax asset. We would have created a deferred tax asset in 1920. And when it is actually allowed in 2021, we will reverse the deferred tax asset. So, this is called creation. This is called creation, and this is called reversal. So, in year one, you create. And in year two, you reverse. If there was no year one, and if this was the first year, then it would have been a creation of a deferred tax liability in this scenario. Okay. Right? So, what you need to understand is you have created deferred tax asset here, and now you'll reverse the deferred tax asset here. What is the deferred tax asset? Deferred tax asset is timing difference of 20 multiplied by 30%. So 6 was created in 2021. Okay, this will be reversed in 21, 22. The first bit. Is that clear? Any doubt in the first bit? Let me see if any questions. Any doubt on that? Okay, no questions. Fine, good. Now, coming to the second bit. What is the second bit? No question. Right. Fine. Good. Interest to financial Interest to financial institutions accounted in the books on accrual basis, but actual payment was made before the due date of filing return and allowed for tax purpose also. Now, please note, friends, when we talk about Section 43B, I hope you have learned income tax. When you talk about Section 43B, there are some items: payment of bonus, payment of your statutory dues, GST dues, loans, interest to financial institutions. All of those, if they are paid before the filing of income tax return, then those are allowed. If the item is allowed, right, even if it is paid after the due date, but before the filing of income tax return, then there is no disallowance. If there is no disallowance, then it is an item. It is not an item of any difference at all, because there is no disallowance, there is no difference. So here, what you need to understand is, because as per 43B, if the amounts are paid before the filing of income tax return, they will be allowed. That means this will be allowed. So there is no difference. Okay. Then donations to private trust made in 2021 not allowed for tax. If it is not allowed, means what? It is a permanent difference, so no impact on deferred tax asset or liability. So the only impact on deferred tax asset or liability is the reversal of deferred tax asset tune of 6 lakhs. Okay, I hope I have I've thrown some light on DTA, DTL. For Wasim, if you have any more questions on that, you can definitely let us know. And again, I'm repeating, AS22 full standard is available on the YouTube channel. With entire content is available on our YouTube channel. You can make use of that. Okay, right. Then raw material valuation as replacement cost in AS2. Okay, so I think there is one famous question, MP1, MP2. They keep on asking the same question in inter also and in final also. Let me see if I can just pull that question out and we can solve it, right? So just a moment. Right from the time I have been studying the same question, MP1, MP2. So I think it's there in the CA final course, the latest material also. Let's pick it up for you. See this famous question. You can see this in multiple examinations also, right? And I think there is a replacement cost given. Oh no, sorry, this was not a replacement cost. I got overconfident. This is one byproduct. This is on replacement cost again. Though it is from CA final, it would be the same question that would be applicable for inter also. So let us see what is the question about. Opening in, so they have given some information. Opening inventory, finished goods 1000 kgs, raw material 1100 kgs, 11,000. Okay. Purchases 10,000 of 1 lakh. Then you have labor 76,500. Overheads fixed 75,000. Sales they have given 10,000 units. Closing inventory 900 and 1200. Okay. Now the expected production for the year was 15,000 kgs of finished. Now why is this expected production important? Expected production is important because based on that you allocate the fixed overhead. Okay. Due to the fall in market demand, the sales price of the finished goods was 20 per kg. Now we'll have to see what is the cost per kg and what is the cost at which we are selling. Fine. And the replacement cost for the raw material was 9.5 per kg on the closing date. You are required to calculate the closing inventory as on that date. Now, when you get this kind of question in the examination, this normally, if you see, sales was happening at 28. Now sales will happen at 20. The prices, that is one thing. Second, this finished goods 1,000 and 25,000. We can assume that the entity is following FIFO method and that finished goods is sold off. If you follow first in first out, that 25,000 of opening finished goods would have already been sold off. Right now, when it comes to raw material, one thing in this question which is easier for us is raw material 1100, 11,000. And here 10,000, 1 lakh. So the per unit cost, of this raw material is 10. So what I'll do is I'll start noting down. Raw material is 10 rupees per unit. right? Then labor is 76,500. Now 76,500 is for how many units? Now please note, opening inventory is 1,000, closing inventory is 1,200. Opening inventory is 1,000, closing inventory is 1,200, and sales is 10,000. So how much is product? Always remember this golden formula: opening inventory plus production minus sales is equal to closing inventory. Okay, this formula, if you remember, please note it down somewhere. Opening plus production minus sales is equal to closing inventory. Now what do we need? We need the production. How much is the production? Production will be equal to closing inventory. What is the closing inventory? Closing inventory is 1,200 plus closing inventory is 1,200 plus sales is 10,000 minus opening inventory 1,000. Okay, so 1,200 plus 10,000 minus 1,000. So the production is 10,200 units. Production is 10,200 units, right? So what is the labor cost? Labor is 76,500. 500 divided by 10,200 is the production, which gives me 7.5. Okay, if at all there is any error on my side, if at all I'm doing some calculation mistake, please feel free to highlight it. 7.5. Then purchases, raw material we have taken, labor we have taken, overheads fixed. 75,000 is for how many units? 15,000 units. And please note, friends, whenever the actual production is less than the estimated production, you will consider the predetermined overhead recovery rate only. You will not revise the rate. What is the predetermined overhead recovery rate? 75,000 divided by 15,000, which comes to 5. So you will take overhead. How much? 75,000 divided by 15,000, that comes to 5, right? What is the total cost? 22.5. Now, friends, in these kind of questions in the examination, always write the fundamental or the golden rule of inventory valuation. Inventories are valued at lower of cost and net realizable value. That you have to mention. Okay. Now, what is the cost? Cost is 22.5, right? What is the NRV? Net realizable value is your expected value minus cost of completing the sales and cost of completing the production. Here we don't have all of that. We just have that the selling price is 20. If NRV is 20, which is less than the cost, then finished goods will be valued at NRV because it is lower than cost, right? So how many units? 1,200 units, 20. 24,000. Then raw material, I'll note this down. You can also note it down somewhere. Raw material are generally valued at cost. However, if finished goods are expected to be sold below cost, raw materials are written down to NRV, and replacement cost is the best estimate of NRV. You know, this theory you can write. So because raw material are valued at cost, but because finished goods are sold below cost, you will do raw material at replacement cost. So raw material will be raw material. How many units? 9.5, 900 units, and replacement cost is 9.5. So 900, 9.5. Okay, 8550. So the value of inventory total value is 8550 plus 24,000, which gives us 32,550. Any questions on this? Right. So This also you can present. You can calculate this and that. You'll be learning this again in CA final as well. Para 24 of accounting standard 2. Okay, so let me open the accounting standards. What does para 24 talk about? Acha, you gave the answer. See, Sai Sriram, good. You remember the para. In fact, I don't remember the paragraph. You're able to tell that, as per para 24, this is the treatment. I think, you need a thumbs up for that. That is really good. I thought you had a doubt on this. And this is the theory part, what he was referring to, Sai. It's a good thing. Good one, good one. Right. Then cash flow statement, indirect method with adjustment of redemption of debentures and redemption of preference shares. Okay, so redemption of debentures, the solving an entire problem will take a lot of time, but I'll tell you a specific doubt what you have. Okay, now when there is a, yeah, Shreya, I have taken redemption of debentures. Now, whenever there is a redemption of debenture, if you have a specific question in mind, do let me know. Otherwise, I'll tell you the theory or the concept behind that. Redemption of debentures, when you talk about what is happening, there is an outflow. There is an outflow. So there will be a cash outflow from financing activity. There is a cash outflow from financing activity. That is very clear. Okay, there is no confusion in that. Now, what is the trickier part here? Maybe the redemption of debentures are at premium. Even if it is redeemed at a premium, whatever is the entire proceeds which is paid be considered as cash outflow from financing activities. But whenever there is a redemption at premium, so I'll just give you an example. Let us say P&L balance is 1,000 here, 10,000 here. Okay, this is closing. Assume no dividend, nothing is declared. Okay, closing is 12,000. Normally, you would say 12,000 minus 10,000 profit. Okay, but let us say there is a redemption of debentures at 100 premium. Now, this premium will be debited to P&L. So, what you need to do is you need to prepare a P&L account and say, okay, by balance brought down 10,000, right? Then here you have to balance carried down 12,000, right? Then you'll have to premium on redemption. So this premium on redemption of 100 you will consider. And you will have 12,000 plus 1,000 minus 10,000, which is 2,100. This will be the profit for the year. Okay, so basically, whenever there is a redemption of preference shares or redemption of debentures, whenever there is a redemption of debentures or redemption of preference shares, what happens is, there is an impact which goes into the P&L or the general reserve. See, when you're redeeming preference shares and if there is a capital redemption reserve requirement, it will go and impact the, P&L balance or the general reserve balance as well. So that is where you have to be careful. Whatever is the total payment to these, debenture holders and the preference shareholders, that should be treated as an outflow from the financing activities. Okay, this is the underlying concept when we talk about redemption of debentures or redemption of preference shares. Now, where you might get confused in the examination is, for example, general reserve. Just to give you, a perspective, let us say there is general reserve. And some amount of the general reserve is transferred to CRR on redemption of preference shares. So whenever you have these kind of questions, always prepare a ledger account, general reserve ledger account, a P&L account, so that you get to know how much amount has been transferred from general reserve to CRR, or how much is the impact which is going from P&L to CRR or P&L to premium on redemption. Okay, so let me see if I can quickly pull out a question for you. Oh, I thought that. Just a second, I'll put it on charging. Okay, now see this illustration number 11, right? The company redeemed debentures of 20 crores at a premium of 10%. Debenture holders were issued equity shares of 15 crores to a redemption, and the balance was paid in cash. Debenture interest paid during the year was 1.5 crores. Okay, so 1.5 crores is a cash outflow. That is very clear on interest on debentures. That is one. Second, redeemed debentures of 20 crores at a premium of 10 crores. So 20 crores, premium 10%, 2 crores, total 22, right? Out of this, as far as cash flow statement is concerned, what we are bothered about is what is the amount which hits the cash flow, or how much of cash is going out of the company, right? So how much of cash is going out from the company? They say 15 crores of equity shares were issued, which means 7 crores is the outflow. So if you see the cash flow statement, you would see here redemption of debentures is only 7 crores shown here. Why only 7 crores? Because 15 crores is issue of equity shares and only 7 crores is paid by way of cash. Okay. Now, this is what I was, mentioning to you. If you look at the question number 2, it just says, how will you disclose the following items? Premium was charged to PNL, okay, and they have not shown PNL, so that is a different thing. Okay, so that is a broad treatment. If you have any specific question which I need to take it up and solve it here, I would be happy to do that assessment. Any more questions on any other topics from accounting? I'm surprised that I'm not getting questions and you don't have doubts. So that is it's good in one sense, but I was expecting more questions and more doubts from your side. I've tried to cover a few topics from my side and other topics what you had asked. Anybody having any doubt, please feel free to ask. Add back where, Shreya? No, so don't learn it as you have to add back the premium on debentures to the P&L balance. Don't learn it that way. Okay, what you need to learn, understand is, as I told you here, as I told you here, balance brought down 10,000. Okay, so here P&L opening balance is 10,000, closing balance is 12,000. You would see that the profit for there normally you would say 2,000. Okay, based on the balance sheets. Right now, if there is a premium of 100 on redemption of debentures, if there is a premium of 100 on redemption of debentures, which is added or which is debited to this P&L already, then you'll have to remove that impact and you will get to know that the profit for the year actually is 2,100. The total profit for the period. Okay. Now, if, for example, the profit given to you, they say the profit for the year is 5,000. Okay, and rupees 200 is debited on account of premium. Now, this premium which is debited to the P&L of 5,000, that premium does not pertain to an operating activity. Correct. Now, if something is debited to P&L which is not pertaining to operating activity, you will have to add it back. You will have to add it back, and you will have to show that separately as a cash outflow from financing activity. Okay. Now, when it comes to redemption of preference shares, again, there, if you are using P balance to create a capital redemption reserve, at that point of time, that portion of CRR, whatever you are debiting to P&L, it has to be excluded from that and shown as an outflow in the financing activity. Okay, so let me see if there is something on preference shares. Now here, for example, in this particular question, why are we adding this premium on redemption of preference shares to the net profit or loss account? Because premium on redemption is debited to P&L, but that is not a part of operating activity. So we are adding it back, and we will show it separately under the redemption of debentures. So let me show you this question number 5. Yeah. Now this is the question. Okay. Question number 5. Now here they have given reserves and surplus, two balances, 8,40,000 and 11 lakh. And students, please note here 20 year 0 is first, year 1 is next. Okay. Most generally it should be year 1 here and year 0 first. Assume that this is this year and that is that year. First year and second year. You have to be very careful. Now coming to reserves and surplus, see what is the opening balance? 6 lakhs. So let me just note down these numbers. General reserve 6 lakhs and 7,60,000. Okay, then P&L 2,40,000 and 3,40,000. Right. Now, let's come to the information. Company sold one property, plant and equipment. This is a different adjustment. Company also decided to write off another item of PPE. Okay. Depreciation on PPE was so much. Okay. Company sold investment 50K. Debentures and preference share capital were redeemed at 5% premium. Debentures and preference share capital are redeemed at 5% premium. Now, there are multiple ways to do this. Now, what you have to understand is what will be the impact of redemption of debentures and preference share capital at 5% premium. You will debit that particular amount in the P&L statement. Correct? So, balance of P&L that you get 760 and 340. So P&L is there, general reserve is there. This balance what you get is after debiting the premium redemption of preference shares. So you should say that profit for the year is only 240 and 340. See, that is one way you can do it. You can say that the difference between 240 and 340 is the profit for the year. So what I'm trying to say here is you can say this, but also there is a transfer to reserves. I'm not considering that. If you consider transfer to reserves, so this also is an increase. Okay. And there are other adjustments given, which I'm not considering. So what you can do is, if I'll just, can quickly take you through the presentation part. Yeah, here. So there were some inventory adjustments also. Okay. Just a second. Okay, so there was an inventory adjustment also. So that 24,000 is the adjustment because of inventory adjustment. That is why instead of 1 lakh, they have presented it as 76,000. And there is a transfer to general reserve of 1,60,000 because of which the general reserve balance has increased. Then what they have done is they have adjusted the premium on redemption of preference shares and premium on redemption of debentures. Now, why have we added this back? We have added this back because this particular item of on redemption is not an item pertaining to your, operation. These are items pertaining to your finance activities. So this 6,000 and 6,000 of premium will be adjusted here in your financing activities, 6,000 here and 6,000 here. So what are you doing? Basically, you are adding back to the P&L because it was debited to P&L. So whenever you have to add back an amount, you have to see whether it was debited to P&L or not. If it was debited to P&L, you have to add it back and deduct it in the financing activity. Okay. Can you solve some questions in A16? Explain AS10. I need to, you need to ask me specific question. I need this topic in AS10. I'll take that up. I cannot solve or discuss the entire AS10. If you want a revisionary concept on group 1, it is already there on our YouTube channel. You can, go through that, where I've covered all the standards in about, I think, 3 hours time of group 1. Okay. Can you solve question in A16? So I'll take one question in A16. Shreya, I hope your doubt is clear on that. Because we have debited these items, we are now adding them back. Okay, so A16, I'll take it again. A16 is group 1. So let me think this is a group 2 thing. Yeah, Manish, capital maintenance will come up after that. I'm going in an order. Okay. Just a second. There's some issue with my connection out here. Okay. So let me just pull out intermediate question on A16. New syllabus for on accounting. RTPs. May 22. Oh, there is some issue, I guess. Just a second. Give me a moment. Yes. I hope the screen is visible. If it's visible, just let me know, yes or no, because there was a connection disruption because of which the screen sharing was stopped, right? So yeah, right. So someone wanted question on borrowing cost, so let us do this. An enterprise has constructed a complex. Okay, this is a theory question. So anyways, I'll take this theory question and then I'll move to one previous year RTP and do it. An enterprise has constructed a complex piece of equipment, qualifying asset, that is to be installed on the production line. Guys, please don't get into personal chats. We'll have to remove you from the channel. Okay. Please, no personal chats. If you want to learn something, you can be on the channel. Otherwise, no, if no one is forcing you. Okay. Yeah. So now here we have a question which says an enterprise has constructed a complex piece of equipment, a qualifying asset, that is to be installed on the production line of a manufacturing plant. The equipment has been constructed over a 15 months period. Generally, the qualifying period or substantial period of time is 12 months. On installation, certain calibration are required to desired level of production before it is finally commissioned. This process is expected to take approximately 2 months, during which the test runs will be made. Should the borrowing cost attributable to borrowings pertaining to 2 months period should be capitalized. Okay, now what is the question here? The question here is, there is a piece of equipment. It normally takes, or it has been constructed over 15-month period. Now, there are some calibrations required, more like a test run, which has to be done. Right now, do we capitalize the interest component pertaining to the 2 months period of test run? That is what is the question. Okay, now what you have to understand here is, till the time the asset is ready for its intended use, and the asset is ready for its intended use, cost which is incurred can be capitalized. Now the question is, should the test run be considered as a period in which the machine is, or the equipment is not yet ready for its intended use? So what you need to check is the asset fully ready? Is the asset fully into the commercial production? Have we finished all the tests? Have we finished all the trial runs? Till the time all of these are completed and the equipment is commissioned, whatever is the borrowing cost, right, that will be considered, and you will be able to capitalize the borrowing cost relating to that period as well. Okay, you cannot say that the machine is completed substantially, so we do not need to capitalize the borrowing cost after that. That should not be the right approach. What you should understand is, has it reached the commercial level of production or desired level of production? Till the time whatever activity is going on, you will be capitalizing the cost related to that. Now this principle is also in line with what you learn in accounting standard 10. Till the time the equipment or the item is ready for its intended use by the management, till the time whatever is the cost incurred, those costs will be capitalized. Okay. Then second part talks about capitalization of borrowing cost when the qualifying asset has been constructed but marketing activities are continuing. See, once the asset is ready for its intended sale, then you will stop capitalizing the borrowing cost, right? After that, you will do some marketing activities. You are not able to sell. You have to keep it in the godown. You have to keep it in the warehouse. Whatever happens, the borrowing cost will not be capitalized. So you should not be capitalizing the borrowing cost of this. So let me do a numerical also, as suggested. RTPs. So let me see November 21 if you have something on borrowing cost. We're not able to search. Okay, so just okay. So for all of so we have all of these RTPs right from May 18, the first examination that was conducted till today. All the RTPs are subject wise, MTPs are available subject wise. The past exam suggested answers are available. Please make use of these resources and practice as much as you can. Okay, the institute provides only 2-3 years of items of RTPs. After that, they just remove it. We have compilation of everything here. Please make use of this, and it will be helpful to you. Right. So coming to this. Question number 20. Now, what are the questions about? It's about the borrowing cost here. Yeah. In May 20, Omega Limited took a bank loan from a bank. The loan was used to specifically for the construction of a new factory building. The construction was completed in January 21, and the building was put to use immediately thereafter. Interest on the actual amount used for construction of building till its completion was 18 lakhs, whereas the total interest payable to the bank on the loan for the period till 31st March is 25 lakhs. The company wants to treat 25 lakhs as part of the cost of factory building and has capitalized on the plea that the loan specifically taken for the construction of the factory. Explain the treatment in line with provision of AS 16. Right, now here, pretty simple. They have taken a loan in May 20, and in January 21, the construction was completed. So you can capitalize the interest only till January 21. You cannot capitalize interest beyond that period. Why? Because in January 21, the asset is ready for its intended use. After that, for the next 2 months, whatever is that has to be charged off to the P&L. You cannot capitalize entire 25 lakhs. A simple question. I think I have to go back one more RTP behind to get some good question on A16. No, so I think generally it has been the same, and there will be a few numericals. You can actually go through the RTPs and do it. And the thing is, the standards which you are scared of, actually you are getting simple questions, right? And these would be the kind of questions that would be even asked in the examination. You can refer to the past exams paper as well. So I have to remove Rajasekhar out of the channel. Okay, fine. Let me take up the next concept, which is the capital maintenance concept, asked by one of the who had asked that capital maintenance concept, Manish. Yeah. So okay, now let me take a very simple example and explain to you what is this capital maintenance concept. Let us say someone started a business and they put 10,000 of capital. Okay, it's a very simple example. And let us say inventory costs 10 per unit. So how many units can be purchased? 10,000 divided by 10, you can purchase 1,000 units of inventory. Right? So 1,000 units of inventory can be purchased at 10 and you get business, right? Assume for a moment this is purchased and he also sold all the 1,000 units of inventory, for example, at let us say 15. What is the profit? 15 minus 10, 5 is the profit per unit. If you take 1,000 units, the total profit that you get, so this is the capital, this is the profit. 1,000 multiplied by 5, which is 15,000, 5,000, right? So ending capital is how much? 10,000 plus 5,000, 15,000. Now assume for a moment has withdrawn drawings of 5,000. Now what is the closing capital? Closing capital is 15,000 minus 5,000, 15,000 minus 5,000, which is 10,000, right? Now with this 10,000, he can again purchase 1,000 of inventory at 10 rupees. But assume for a moment in the next year, inventory prices are 12. Inventory prices are 12. So how many units can be bought? He can purchase only 10,000 divided by 12. So he can only purchase 833 units, which means his capital has eroded. Though he has made profit and withdrawn the amount, he will not be able to purchase 1,000 units. He'll be able to purchase only 833 units. Now, the concept of capital maintenance is that you should have sufficient capital in the business so that you can maintain your level of business. For example, here, how many units he needs to purchase? He needs to purchase 1,000 units. For 1,000 units, how much is the capital he needs? He needs 1,000 multiplied by 12. He needs 12,000. So his drawings cannot be 5,000. His drawings has to be 3,000. So he has to maintain capital of 12,000 so that in the next year he can purchase inventory at 12,000 units and do his business. This is what is the concept of capital maintenance. Okay. Okay. So till the time I get the next question, I'll get on to my work. If any one of you have any question, preparing. Otherwise, purchasing power in financial capital maintenance. Okay. Now, purchasing power means what? So, purchasing power basically takes into account the inflation. So here, if you see, there is an increase of 20%. There is an increase of 20%, right? So, this if you do -1, there is an increase of 20%, which means the purchasing power of money has reduced. Now, there are two concepts which you learn at in the capital maintenance. One is obviously at the current cost. Financial capital maintenance at current, one is at the current cost. Then you have a concept called financial capital maintenance at current purchasing power, right? And then you have physical capital maintenance. The only difference is in one case, use the index. Okay, so if you talk about physical capital maintenance, you use the price indices. And if you talk about financial capital maintenance, then you use the individual, increase in the specific price. For example, what we learned here we are talking about financial capital maintenance because here we are talking about financial capital maintenance because we are using increase in the price of specific inventory. Okay, right. So this is what we are doing it here. And there is a concept of physical maintenance, physical capital maintenance, where you look at the price indices which are applicable to each asset. Clear? If a company borrows 3 different loans to purchase a single machinery, how to capitalize the interest cost? So if it is a specific borrowing, sorry, there is some external disturbance. So if you borrow 3 different loans to purchase a single machine, you have to see what is the interest you are paying on each of these loans. And then you will total up all the interest and you will capitalize it to the specific machinery. Okay, so you want me to explain the problem? Sure. Let me take up the problem. Or in fact, Mr. I know your name is Lucky. I can solve the problem, and I would rather, already we have a problem with us. We'll actually release that on YouTube after the session ends. That will be fine. I'll still take you through the problem, which is, given in the study material. Okay, so yeah. Okay, now capital maintenance, basic concept I have explained it to you. Okay, now first thing is historical cost, right? What is historical cost? Historical cost meaning you will use the original cost when you started the business. So here a trader started business on 1st of January of year 1, 12,000 represented by 6,000 units of a certain product at 2 per unit. So let us say units, rate, total, and remarks. 6,000 units at 2 multiplied by 2, which is 12,000. Okay, now this is the capital required. Achha, you wanted me to explain the problem in AS1. Okay, sorry. I thought you wanted me to explain the capital maintenance, which I already just now. That was in December 21 paper, if I'm not wrong. Let me just pull that out for you. And this is the question you are referring to. ABC Limited was previously making provision for non-moving stocks on not issued for the last 12 months. So this is the way they're valuing non-moving stocks or making a provision for stocks. Now the company wants to make provision technical evaluation during the year ended 31st March of 2021. Total value of the stock is 133.75 lakhs. Provision required based on technical evaluation is 4 lakhs, and provision required based on 12 months issue is 5 lakhs. Now, what is the question? Discuss the disclosure requirement of change in accounting policy in above cases as per accounting standard 1. Now, the first thing that we need to understand is when there is a provision for non-moving inventories, making a provision for non-moving inventories is an accounting policy. How do we measure that? Sometimes, so in one case it says they are based on 12 months not issued. In 1 month, it is in the current period they want to do it the technical evaluation, right? Now, when there is a provision to be made, what we are doing here is how do we calculate that provision? That is what we are changing. So, like provision for bad debts, instead of 2%, we are making 2.5%. Similarly, here also, that estimating that amount, the basis of estimation of that amount is what we are changing. Okay. Now, this estimation that we are changing, this is not a change in accounting policy as such. Okay, it does not amount to change in accounting policy. It is purely a method of estimation which we are changing. So what the company should do is the company should say that the non-moving provision of inventory, is calculated as 4 lakhs based on technical evaluation. Earlier, it was calculated using, provision or using 12 months not issued. If they would have done it using the earlier method, there would have been a difference of 1 lakh. And also see, friends, the difference is only 1 lakh on an item of 133 lakhs. So it is not a material item as such, right? So not disclosure, but some disclosures, we don't know the size of the company, but some disclosure regarding the company, the way it is providing the provision for non-moving inventory based on technical evaluation. That is what they have to disclose, and they have to say there will be an impact of 1 lakh had they followed the earlier method. Okay, so that will be sufficient aspect with respect to disclosure. AS10 recognition criteria. Sure. Now, what is AS10 recognition criteria? It says an item can be recognized as a property, plant, and equipment if condition which has to be satisfied, the enterprise would get future economic benefits, and the second criteria is cost can be measured reliably, right? That is what is the recognition criteria for a property, plant, and equipment under AS10. Now, what does that mean? When we say we will get future economic benefits, will the entity get future economic benefits from using that particular item? Now, future economic benefits can be direct or indirect. For example, when I'm using, let us say there is a camera in front of me. Now, when I'm using that camera to record lectures, this will give me future economic benefits. Now, because that item is giving me future economic benefits, we will be able to recognize that as an item of property, plant, and equipment. But also note that it has to also meet the definition of asset. That is, it must be in the control the entity, the resource must be in the control of the entity, the resource must be able to get the benefit in the future by controlling that particular asset, by using that particular asset. So your plant and machinery, your vehicles, everything which the entity has a control over, which it is able to use, which it is able to get benefit from in the future, and the cost of which can be measured reliably, then in that case, you will recognize that item as an item of property, plant, and equipment. Otherwise, you will have to expense it off in the statement of P&L. Okay, so I will specifically, take you through the definition. So what you need to understand is the definition first. The cost of an item of property, plant, and equipment should be recognized as an asset if it is probable that future economic benefits associated with the item will flow to the enterprise. Again, probable when we say greater than 50% chance that the future economic benefits associated with that particular item will flow to the enterprise. And second, the cost of the item can be measured reliably. Now, friends, please note one thing. Cost of an item being measured reliably, most of the cases you'll be able to measure. I paid 5 lakhs to buy a car. I am able to measure the cost reliably. But sometimes if I'm exchanging an asset, I may not be in a position to measure the cost of that asset reliably. For example, I have a very antique, let us say art piece at home. Okay. And that art piece, I say it is worth 5 lakhs, for example. And somebody else says, no, it's worth only 3 lakhs. I say, okay, giving that art piece, I buy another asset or I get another art piece. Okay. Or another asset, for example, I buy Now, if I'm giving a painting worth 4 lakhs and buying some other asset worth, whatever is the value of that asset, this painting cost cannot be measured reliably. So you will have to look at the other item that you're acquiring. And if the other item is also unique, then it will be sometimes difficult to measure. But 99.99% of the cases, the second condition that is highlighted here, the cost of items can be measured reliably, is fulfilled. The only thing I need to check is it is probable that future economic benefits associated with the item will flow to the enterprise. Then you can recognize the item as an item of property, plant, and equipment in the books. Now, that is why general repairs and maintenance, which do not add much value, those are expensed off and those are not capitalized as a part of property, plant, and equipment. And the definition: property, plant, and equipment are tangible items, first, which are held for use in the production or supply of goods, services, for rental to others, or for administrative purposes. Now you have to pay additional attention to this item for administrative purposes. Why? When you are using an item for an administrative purposes, then it will not give direct benefits. For example, there is an air conditioning in this particular room from where I am conducting this session. Now, this air conditioning equipment, this does not give us direct benefit. I will not be able to say how much of the sales this particular AC has given me. But without this AC in this 43, 44 degrees temperature, it will be difficult for me to conduct a live session, right? So it may be used for administrative purpose as well. So it has to be used for production or supply of goods or services. Production, for example, we are creating content. I'm giving Indigo an example specifically so that we can relate it. Or you take any case of any plant and machinery, they are used for production of goods or supply of services, or rental to others. I have a car which I will give it on rent to others. My company has a car, I'll give it on rent to others. That's my business. Or for administrative purpose, and are expected to be used during a period of more than 12 months. So you'll also have to use it for a period of more than 12 months. This kinds of PPE, and this gives the recognition criteria. I hope Sanjay, it is clear. If you have any doubts on that further, you can definitely let me know. So till the time you come up with other questions, I'll start on to my work. Yeah, welcome Sanjay. Okay, so you can see maybe the screen of PPE. I'll be start. Guys, any questions? Keep on, just asking, and I'll pause my work and I'll, get back to you. That is not a problem. So right now I'll be listening to some SFM lectures. I'll be, going through the SFM lectures what Sriram has recorded. Before we give it out to the students, we ensure that at least one of us, either me or either Sriram, we go through the lectures and ensure that everything is proper and done well. So that is what I do at least for a couple of hours every day. So I've gone through almost 80% of your CA inter content and CA final going through right now. And it's studying again. That is what we are doing. Material versus immaterial. Could you give me some general information about this? Now, material versus immaterial. Uh, Sai Sriram, you have to ask me specific. Yeah, see, if you say AS24 is a big standard again, okay. Ask me specific about that. I'll definitely be able to, answer that. That is what is this session is about. So, if you have any specific doubt on AS24, please let me know. I'll, put it up. Material and immaterial. See, what is material? Material is something very important. Okay, so anything let us say you have two documents. One is your passport, and other one is a normal diary. Okay, and if you lose the passport, it is material because that is a very important document for you. But if you lose a diary, it may not be very important for you unless it's a personal diary which has a lot of secrets and bank account details and passwords and all of that, right? So it's a concept where you decide what is important. Now when it comes to financial statements, let us take companies like Reliance has turnover of lakhs of crores. For them, items of 1,000, 1,500, 2,000, 10,000, they would not be material because amount is insignificant. Whereas, similar, if you look at a very small company which is doing a turnover of 5 lakhs, for them, an item of 10,000 would also be material. So, material is something which will change the decisions of users of financial statements. Okay, if you give an information and if it is material, that has an impact on the way the user of financial statement makes a decision. That is what is material. That is the general understanding of the term material. Now you have to understand that from the point of view of the turnover of the company, the size of the company, the nature. Now if there is a related party transaction, even 10,000 rupees of related party transaction is material because users know that this this kind of transaction is happening in the enterprise, right? So if it is a small thing, then it is not material. That is how you can understand. That's a general understanding, and you have specific standards on auditing dealing with materiality, and the framework also gives the definition of what is material, right? So you can read through that. Guys, if you have any more questions, feel free to ask. I am continuing to work whatever I have to work, watching some SFM lectures. Okay, if you have any questions, please ping it on the chat box. As I have been taking up the concepts and the questions earlier, I'll be taking. So there's a question, Mr. Sanjay Kumar. Okay. Typically, as per AS2, valuation of inventories are valued at lower of cost on an NRV, whichever is lower. Why the inventories are valued in the financial statement lower, basically. So it's simply applying concept of prudence. When you know an item, let us say you purchase something for 100. Okay, so for argument's sake, let me just pull up that Excel. Argument's sake, let us say you purchase some item at 100. Okay, and think of it as a normal trading account. Okay, this is two purchases. Okay, and and you have purchased a finished goods, and you know that you will sell this item in the future, and the price has already gone down to 90. Price has already gone down to 90. Normal scenario, what would have done? You would have said buy closing stock 100, and there will be no profit, no loss. But when you know in the future, when in the future when I'm going to sell it, I'll be able to sell it at only 90 on the balance sheet date. See, in the future price will go up again. That's a different thing. But on the balance sheet date, this asset is worth only 90. This asset is worth only 90. So what are you doing? Applying the concept of prudence, you're saying this is 90, and hence there is a gross loss of 100 minus 10. Now you may have a question, sir, why are we not, showing if it is 110, why are we showing it as cost? Because you don't want to recognize gains in advance, right? So by applying the concept of prudence, you will recognize all anticipated losses, but you'll not recognize any anticipated gain. That is the reason why you value it at lower of cost or net realizable value. Just a second. Okay, so another question: What is the main? What is mean by carrying amount? See, carrying amount is nothing but the amount that you show it in the balance sheet. Okay, and some example, it's after accumulated depreciation amount. See, carrying amount is always shown on a net basis after depreciation only. Whenever we say carrying amount for let us say a property, plant and equipment is after deducting depreciation. Carrying amount cannot be before depreciation. Okay, so whenever you're saying, let's say gross block of fixed assets. So fixed assets, let's say 1 lakh, depreciation 20,000. Carrying amount is 80,000. Vittal, so if you have questions, you can ask, then I'll respond. Only then I'll be audible. Otherwise, I'm working. I'm watching some SFM lectures of CA final. Actually, going through them before we, release it to the students. The final quality check. This is again for those of you who have moved in or logged in late. It's not a session. It's more of a doubt clearing session where you can ask questions and I'll be answering. Guys, if you have any questions, you can ask me. As I look, as I get the questions, I'll be answering them. Otherwise, I'll continue to go. Guys, if you have any questions, you can feel free to write it down in the chat box on accounting standards. I'll be taking them up. Any topics which you want me to cover or any concept which you want me to cover, please ping it out in the chat box. I'll be taking them up. So I'm parallelly working, guys. So this is a doubt clearing session where you can ask questions. So if you have any doubt related to any concept in the accounting standard, any question you want me to solve in this live session, I'll be doing that. Otherwise, I'm continue to watch my SFM lectures. Okay, so if you have any doubt, for those of you who have joined in late, if you know there are a lot of questions which students had asked earlier. If you have any doubt, Mr. No, so we have SK Khandelwal, Vittal. If you have any questions, any doubts, you feel free to ask. Cost model and revaluation model, how to apply. Okay, so get a question here. How to apply cost model and a revaluation model. So let me just share my screen. Okay. Let me quickly share the screen and then we'll go on. Yeah. I hope the screen is again visible. I had disconnected the screen share option some time back. Okay. Now, as far as ACE 10 is concerned, your cost model and revaluation model. What do you mean by this? So please note, whenever we look at an accounting standard on asset, we have initial recognition. So initial recognition will always be at cost. Initial recognition will always be at cost. Okay. Subsequent measurement will happen either using the cost model or the revaluation model. Now, what is the meaning of cost model and what is the meaning of revaluation model? Let us just put down the numbers here. Cost model, revaluation model. Okay. Now, let us say original cost of the property, plant and equipment is, for example, 1 lakh, simply put. When I'm just doing a simple example, useful life is, let us say, 5 years. So what is the depreciation per year? Depreciation per year will be 1 lakh divided by 5, which is 20,000, right? Now, let us say we have years here, 1, 2, 3, 4, 5. Using the cost model, what you will do is, I'll just copy this here. You will have original cost, or the gross block that we call. Sorry. You have original cost of 10,000, depreciation of 20,000, and carrying amount of 80,000. Next year, again, the cost will be depreciation. Okay, the next year will be 20,000 plus another 20,000, 40,000. The carrying amount will be 60,000, right? Similarly, here it will be 40 plus 20,000, and this will continue. Okay, and your carrying amount will be. This is the cost model where you have the original cost less accumulated depreciation. You will show the carrying amount of that asset. Now, what is the revaluation model? What accounting standard 10 allows is for an entity to value a class of assets, using the fair value. I'll just simply, I'll not get into details of how that fair value is computed and all of that. They can take the market evidences and they can calculate the fair value under accounting standard 10 using the revaluation model. Now, what happens when the entity applies revaluation model? Say, for example, at end of year 2, at end of year 2, fair value of PPE above that we have calculated is 70,000. So what you will do is, normally you will calculate the carrying amount under the cost model till the end of year 2, which you got as 60,000. Now the fair value of PPE is 70,000. Fair value of PPE is 70,000, meaning to say you have to compare this 60,000 with this 70,000. You have to compare this 60,000 with this 70,000. Now there is an increase. Increase means gain. Now that is where you have to understand where should we take this gain to. So what the standard says is, first time you have to check whether it is upward or downward. Okay, if it is upward, first time, if it is upward, then you have to take it to revaluation surplus. You have to take it to revaluation surplus. You cannot take it to the P&L. If it is first time, you have to take it to revaluation surplus. If it is downward, first time if it is downward, then you have to debit it to P&L. Okay, are we clear? If it is an upward revaluation, you will take it to revaluation surplus. If it is a first time downward revaluation, you will take it to P&L. You will take it to P&L. Then subsequent. Now, when we talk about subsequent revaluation, how should we do that? When we talk about subsequent revaluation, if first time was upward, okay, if first time was upward and subsequent is also upward, then again you will take it to revaluation surplus. Confusion. If first time revaluation surplus, it is credited. Okay, it is credited. Then if it is subsequently, if it is downward, then what will you do? First you will debit revaluation surplus, okay, and balance debit to P&L, right? So for example, now this fair value of PPE 70,000 at the end of year 2, so you'll basically compare this with this particular 60,000, right? So what is this? This is an upward revaluation first time, so there is a gain. What will you do? You will say debit PPE, credit revaluation surplus by how much? 10,000. Okay, I'm just passing the net entry. I'm just passing the net entry, right? There are two ways to do it. One, you knock off the depreciation against the original cost. You knock off the depreciation against the original cost. So what happens is, I'll just pass that entry as well. This is the second entry which would come up. First, what is, you will debit the accumulated depreciation of 40,000 and you will credit PPE 40,000. Okay, so what happens with this? With the net value or the carrying amount of the PPE comes to 60,000 and then you will debit PPE by 10,000. So then carrying amount of PPE will be 70,000. Now, what do we do with the 70,000? In the future, you will charge depreciation of 70,000 divided by 3, 23,333 every year. 23,333 every year, right? Now, the second aspect, initially, if it is a downward revaluation, you will debit to P&L, and subsequently, if there is upward, to the extent debited to P&L, you will credit to P&L, balance credit to revaluation surplus. And if it is subsequently, if it is downward, then again you will debit to P&L. Right. So this is a broad treatment of revaluation surplus when the entity follows a revaluation model under the accounting standard 10. Okay. Sometimes what the entity does is, instead of transferring this accumulated depreciation to PPE, you can increase this value, original cost, and also the depreciation, so that the net amount is stated as 70,000. That is also possible. That treatment also can be given. So what I'm trying to say here is 60 has become 70, right? So carrying amount is 60, fair value is 70. So what is the increase? Increase is 70,000 divided by 60,000 minus 1. If you get 16.667%. So what you can do is revised gross accumulated depreciation. So you can pass one entry saying, what is my original gross block? Original gross block is 1 lakh. 1 lakh, right? 1 lakh is the original gross block. This divided by 60 multiplied by 70, you get 1,16,667. Basically, you will increase it by 16.667%, and accumulated depreciation also 40,000 divided by 60 multiplied by 70 will be 46666.67. So this minus this will be 70,000, right? So this also can be done if the entity doesn't want to offset the accumulated depreciation. Answer presentation of A's question. If it is, see, if it is a working related thing, you have to do the workings that we have done in the class, or you can follow the study material, right? Then if you are looking at something, case based study question, you have to explain the relevant provision or concept from accounting standard, analyze the facts of the case, and give conclusion. Conclusion is mandatory. A lot of times what happens is students don't write the conclusion and they don't get the marks. So for example, if the question, even in a numerical question, if the question says what is the value of inventory, you have to calculate the total value of inventory. Don't just leave it at finished goods and raw material and be done with it. For example, we did one question here, right? Where was that question on inventory? Yeah, this question. Here, this total will carry 1 mark. If you just calculate this 24,008,550 and not show this, you will not get that 1 mark. So again, thanks a lot for asking the questions. I hope some of your doubts were resolved. Most of your doubts, doubts whatever you asked were resolved, and you could get some more clarity on some of the important questions in the session. Right. We will also upload. We'll be uploading a few revision sessions on accounting standards. It will get uploaded soon. That is there. Can I write own words in answer in A's question? Otherwise, actually, Mitchell mentioned the provision of answers. Can I write it own words? See, you have to retain the essence of the concept. Okay, writing in own words means you cannot create your own definitions. For example, someone had asked recognition of PPE. Okay, now those two things, the future economic benefits will flow to the enterprise, and the cost can be measured reliably. You have to include that. Only then you will get marks. If you write your own definition, fixed assets are or property, plant and equipment are resources which are controlled by the enterprise, and you make your own kind of definition, then you will not get marks. So definitions for sure, or for example, if you look at leases, finance lease and operating lease, those 5 conditions, you have to write those specific technical terms. Okay, need not reproduce it as it is, but major part of the technical terms should be covered in your answers so that you'll be able to secure good marks, right? Thanks a lot for whoever could join in, and I hope this session was helpful. Okay, so all the best for examinations. Prepare. Anyways, we do have forums where you can anytime come up and ask your questions, and make use of the free resources that are available. Yeah, thank you.